In this episode, we're talking about how to invest through stock market corrections.
Welcome. Thanks, everyone, to tuning in. Today, we're talking about market volatility. We've been seeing a lot of it out there, even a little bit of a market correction the past couple weeks here in some parts of the world, even bear markets. So what we wanted to talk about today is developing a process around managing your emotions when stock prices come down.
Right. Yeah, I think it's really important to know that. I mean, it's normal to feel anxious in a time when we're seeing corrections in the market, when markets are coming back a little bit, and that's normal. It's completely normal to feel. But what's really important is to have control over those emotions. You don't want to make an emotional decision with your investments. And so it's just important to recognize those things. And these things are very normal. I mean, they happen all the time. On average, we get a market correction of about 10% every single year. So this thing is completely normal, what's going on right now. And it's just important to manage it.
We know markets ebb and flow, and we know we can't predict the direction the market's ever going to go. And we know at some point that our investments are going to be down, Grant.
Yeah, and actually, I just read a really good line about this. The writer is basically saying that it's really difficult to predict the weather, but you have a really high degree of confidence in predicting the seasons. And so we know what's going to happen on a more longer term basis. We know the seasons always happen the way they happen, but on a shorter term basis, you're trying to predict the weather, even tomorrow or the next day, is somewhat difficult. And the stock market works very similarly to that, actually. So yeah, we do see a lot of these ebbs and flows. And so getting back to our point of this, it's important to manage things and ask yourself a few questions when you're looking at your own investments. So
it can feel uncomfortable when your investments are down, and like you mentioned earlier, we don't want to be making any decisions while we're under the influence of our emotions. And if we are making decisions, we better have a process in place so that it's not actually the emotions driving it. So today we're going to walk you through a couple tips, and it starts with asking yourself questions about your investments when they're down. Question number one: other than price, what has changed with your investment?
Yeah, I mean, that's a really good question, because if you liked the company or the asset you were buying 6 months ago and nothing material has changed, management's still the same, the assets they own are still the same, roughly speaking.
Cash flows,
still the same. If you liked it 6 months ago and now we're in the middle of a market correction, so the stock price is cheaper, you have to ask yourself what really has changed with that investment, and if none of those other factors have changed, it should still be a good investment for you. And so that's just really important to keep in mind. And aside from any material changes, it's still a good investment.
Question number two: are the original reasons I invested in the company still valid today?
Yeah, and I think that gets back to exactly what we were talking about in the first question, is if you like the company, you liked it for whatever reasons you bought it in the first place, whether it's the cash flows, it's the management, the products. I mean, all those things if you've got a good reason to invest in it in the first place, you just have to ask yourself again, what has changed in that? And if nothing has changed, then it's still a good investment for you. And so I would say hang on to it at the very least. And now if it has changed, and maybe market conditions have caused it change in that, depending on the type of company or asset it is, then I mean, maybe you have to question whether or not it was a good investment in the first place. But all else being equal, a market correction should not shake you off of your original plan for investing into it.
Question number three, and you've already kind of touched upon this one, Grant, is if I liked the investment at a higher price, then why would I not be willing to hold the investment or purchase more of it at a lower price if the business is still the same?
Yeah, I mean, this reminds me of our good friend Larry Sarbit there, because he uses the example, if you're thinking about investments like going to a grocery store. Well, we know in Winnipeg that when bread goes on sale, people go bananas and start buying bread like crazy. And yet they don't treat their investments the same way. And we would argue that if you really like the investment before, and then all of a sudden there's a market correction, it's just like the investment going on sale, and in fact you should be going bananas over that and just start buying more of it, or as much as you possibly can.
Yeah.
And so yeah, I mean, it's a good example. Why do we buy groceries on sale but we won't buy our stocks on sale?
Totally. Like when we invest in a business, we're looking at things like the quality of the business, the profitability of the business, any short term noise that affects the stock price or pulls the market down, and when our company gets pulled along with it. At a lower price, we're actually looking at this as an opportunity, something to be excited about because we get to purchase good businesses, great businesses at significantly lower prices.
Yeah, I would just throw the caveat on there because it is good, obviously, from an investment standpoint, but it has to be managed within your comfort levels as well, and also your time horizon for money. Like if you needed money today and we're seeing a market correction, we can't have that money in something that's going to go have these ebbs and flows. But absolutely, other than that, I mean, if the money's not needed in a shorter term period of time, then these should be looked at as opportunities more than anything else.
Absolutely. So hopefully these three questions will help you to avoid the costly mistake of selling an investment just because the market price dropped down. We work with a ton of business owners, and most of the clients we work with own their homes, and I always love bringing the example back to something that they can understand. As a business owner, you lose contracts all the time. Things occur with the business that aren't as planned. There's no business owner I know out there that just because something negative affects the company in the short term, there's no business owner out there that I know that is instantly selling their business and cashing out.
No.
Same would go for your home. If your home price comes off, you're not running to the market to sell it at that lower price. It's these same principles of having that long-term mindset that apply to owning public companies in the stock market as well.
I agree. I mean, if you had the same mindset over if it was your own business or your home or any other long-term asset, like you say, as it relates to the companies you own or the other assets you own in your investment portfolio, then you'd be far more successful over time. And so that's the mentality that we try to instill with our clients, and we encourage the same with you. It'll end up being a far more successful investment strategy for you in the long run.
Great. Well, with that, we will close this episode off. You can check out our website at www.whitehoustonwealth.com, or you can get in touch with us at whitehoustonwealth@nbc.ca. So we're always open to hearing questions. If there's something that you want us to talk about, or something that we've discussed that you have an opinion on, feel free to shoot us an email.
Get in touch. Ready?
Aim.
Fire.